Kunj, good afternoon. Continuing to see strength on, when it comes to the broader markets, and the index also gradually lifting higher towards that 11,400 mark now. What's next, Kunj? Post earnings, what are you eyeing?
Yeah, so I think in terms of market monitorables, the remaining part of the earnings season is something that we will have to continue to monitor. Monsoon progress, although largely done, but just in case it turns on the excess side in terms of damage by the floods and all, will have to be monitored. And the most important thing is that the initial demand recovery, which was being seen as a pent-up demand, seems to have sustained and is no more a pent-up demand, but seems to have become a recovered demand. Now, the continuation of that and a further recovery in the festival season that is coming up next few months. So these are the clear monitorables that will be there for the market to keep taking indications from. On the global side, commodity price movement, especially the crude sudden abrupt movement on the upside, will be a negative if that happens. And along with all these geopolitical developments, will something as a news flow will be the monitorables over the market. So these are the things that we will have to keep monitoring. Of course, market doesn't seem to be taking cognizance of any negative factors, if at all any, on the horizon. Right now, it's getting governed continuously by the positive factors only, by the sequential recovery, not looking at the year-on-year degrowth that continues, and probably by some of the money inflow that is continuing. So that is a mix of the factors where we are positioned in the market as of today.
The way the market has been, or rather the way the auto as well as auto ancillary names have moved, and we've been talking about this, almost on a daily basis, the kind of moves that you're seeing on a Motherson Sumi, on a Bharat Forge, or for that matter, it's not just tractors anymore, but even some of the two-wheeler names, the Hero MotoCorp, Bajaj Auto, for instance, they're all seeing a lot of traction. I guess the market is anticipating not just pent-up demand, but heightened activity closer to the festive season. Do you sense that even after the run-up, there are opportunities to buy into for the long haul when it comes to auto ancillaries or two-wheelers?
Yeah, so what has happened is from a sequential recovery, which was witnessed more in June, not as much in May. Of course, April was a washout, and then it moved into July from June. Again, as we discussed earlier, which was being seen as a pent-up demand, now that is no more the case and is sustaining. In fact, if we hear the management commentary of quite a lot of auto OEMs and more so of auto ancillaries, whose results have come in last few days or a week or so, there is a clear indication that the demand momentum has sustained in July and in the whatever days of August that have come. And quite a lot of auto ancillary companies have indicated that the order book that they have from clients, that is the auto OEMs, is still there for them to be able to do well in August and September. As we discussed earlier, after that festival season demand, how that shapes up has to be seen. In terms of investment opportunity, yes, we all know that the stocks have moved up sharply in the range of 50 to almost 90% from the March lows. But if we look at it from the valuation terms, the auto OEMs have become more expensive. Auto ancillaries to that extent are still available, attractive in some of the cases. And that is where we could see the buying opportunities still being there. Let's also keep in mind that auto ancillaries will benefit from the different geographical mix that they have, the different client mix that they have, the different exposure to right from two-wheeler to tractor to commercial vehicles, of course I haven't picked up, but to passenger vehicles, and the different segments of products that they cater to the OEMs. Within that, of course, with such a sharp movement, the opportunities on a very really screaming buy basis may not be there, but opportunities like Bharat Forge continue to be good opportunities, which also has a defense kicker attached to it.
Kunj, wanted to get in your take on Zee Entertainment. Will be coming out with its Q1 numbers, and while the company has gone full throttle when it comes to its digital platform, the operational performance has been abysmal, as witnessed in Q4. We're not going in with great expectations for Q1 either, on account of reduced ad spends and the general lockdown impact of content as well being very restricted. What is it that you're expecting from Zee?
So very frankly, I don't track that stock, so I won't be able to give any view. In fact, it will be inappropriate for me to give any view. Whatever contextual information that is available, you have already mentioned that if we look at the Q4 numbers of the company, there were quite a lot of unexpected write-offs and which were not seen as positive by the market. If we look at some of the other media companies, not necessarily in electronic mode, but in print mode and all, very clearly the advertisement growth has been lower. In fact, if it's quite a bit of contradiction that if we look at the results of the companies from FMCG sector, from other consumer durable sector and all, we have seen they having been able to protect their margins because they went low on the advertisement expenses because they did not see the demand happening. Now, if we have given them the benefit of doubt because they saved on the advertisement expenditure, that benefit of doubt obviously have to be taken away from the companies which were to be benefiting from the advertisement and which were the like media companies. So that clearly is a negative for the sector.
Kunj, let me get your takeaway on that or follow up in terms of the banks, whether it's wise to steer clear, what's really happening next after this whole round of fundraising. We've seen the banks a little quiet.
Yeah, so I don't think by saying some exotic words and phrases, your view necessarily becomes right. Banking has been part of the whole world economy for years together. And it is very well known that how they operate. It is a very well known business model that yes, they do raise capital, which they leverage to raise further capital and they lend. And obviously in that process, there will be losses which can go up in the downturns of the economic cycle and which reduce in the upturns of the economic cycle. Within that, you make money, a part of which you continue to use by reinvesting and growing the business. And along with that, if the growth rate of the economy as well as your own bank business model is higher, you do need more capital and you do raise more capital. So as I said, I don't necessarily subscribe to these views by exotically putting and very high expression oriented that the banks are bad businesses and all. If banks are not there, the economy won't be there. If the money lenders are not there, if the intermediaries are not there, then nobody will be able to pool their savings. They won't be able to get used for the economic growth. They won't be available to be reinvested in everybody will be sitting at their home with their own money, not knowing what to do, and there'll be no economic growth. So that's one part. The second part is clearly the current bank raise capital for all the well-managed good banks. And if you want name banks like Kotak Bank, banks like HDFC Bank, the track record of their asset quality, their NPAs have been available over the years across the cycles, across the economic cycles of slowdown and of growth. And they have been quite reasonably within well-managed limits of the asset quality or NPAs that could be on a gross or on a net NPA basis. So the strong institutions like these who are raising capital in the current market, first of all, it reflects very highly on the business model, on the management capability, on the ownership quality of these banks, that people are still willing to give them money. And two, obviously, they will use it for growth. Of course, a part of it will go in covering up the NPA losses which have happened, which is a part of the standard business model. There's nothing wrong about it. In fact, why banking, if we look at the quarterly results of a lot of manufacturing companies for Q1, a lot of them have clearly reported losses. Because there was no sale, there was degrowth to the extent of 30% to 70%. Some of them could cover up by reducing costs on advertisements, by reducing distribution costs and things like that. Some other business models did not have that flexibility. They have not been able to control the cost to that extent and have reported losses. So why single out banking? So coming back, all these strong institutions have raised money, which will be used for growth, which in turn will aid economic growth. In fact, if we look at it yet from another side, we have this whole space of borrowers wanting money, especially from the SME, MSME, small businesses. And why small, even bigger businesses, they need money, they need liquidity, including the non-banking institutions like NBFCs and housing finance company. Now, if the banks are not there, if the banks won't raise money to lend, where will the money come from? And as a result, where will the economic growth come from? So I don't think there is anything wrong with the Indian banking system or with the global banking system. There's nothing wrong with the good, well-managed quality banks. There's nothing wrong with the capital being raised. It is being used. It will be used for the growth that will happen. And that is what we will see. And in my view, that is what market is taking cognizance of. market is the biggest god in my view. That's one thing I've learned in the quarter century of my experience. And market wouldn't have been going, of course the corrections may come, market may correct itself to some extent, but market wouldn't have gone up 50% from the March lows had it not been seen the kind of sequential recovery that has been happening, and that is likely to happen. So my view continues to remain positive. A lot of good banks, in fact, amongst the recommendations, if we talk some of them, amongst the relatively higher valuation oriented bank, Kotak Bank is one of the very good picks. If market corrects in the short term, there could be correction, but for medium to long term investors, it continues to remain a good investment. ICICI Bank has recently raised capital, so that gives a lot of cushion to it. So amongst the relatively lower valuation oriented stocks, ICICI Bank is another good pick that is there, and people should remain positive on that.
PCL is quite the buzzer today. Kunj, where do you stand in this entire PSU theme?
Yeah, so multiple things in case of financial performance. Very broadly, in general, we haven't seen anything happening over the years, specifically if within PSU, if we talk of the banking sector, if we talk of some of the select power companies and some of the commodity companies. So that's on the financial performance. The same, of course, has reflected in their share price performance also. Quite a lot of stocks have been consistent underperformers over the years. I mean, it's not a matter of 1 year, 2 year, 3 year, if we take anywhere from 4-5 years and even longer. So that continues to be the case. Some of them are good dividend yield plays, wherever the share price doesn't go down disproportionately post the payment of dividend. So dividend yield, when we talk, this is the most important thing to be kept in mind, that your capital shouldn't erode more than the dividend that you have received. So that continues to be the case. Having said that, because of the lack of clarity from the owner, that is from the government of India, about the future plans, the underperformance has been there. In my view, will continue to be there. Recently, there has been a lot of buzz around the divestment, specifically BPCL name that you were mentioning. My heart wants that to happen, but somehow my head says that I don't know whether it will happen or not, given the kind of continuous extension of dates that we keep seeing and hearing, given the kind of complications that are involved, given the kind of lack of interest that suddenly has gone into the energy space, more so into the oil space. So all those things. So as a result, these become, let's keep in mind, very good trading bets. So all those market participants who can trade them smartly, get in at the right time, get out at the right time, actually go short at the right time, should continue to participate in such stocks. But all those investors who really want to sleep on their portfolios, who want to build low risk, low return, or rather risk adjusted return oriented medium to long term buy and hold portfolios, will not reach anywhere by buying into these companies and holding on to them.
Okay, fair enough. That's an honest take coming in on that entire basket. Would you be playing the consumption theme with hopes of a revival from the rural side and spending picking up as things normalize, Kunj?
Yes, the one word answer to your question is yes. Of course, we have to attach a lot of qualifications to the yes when we say. One thing that the valuations, of course, something has to be kept in mind, although my view has always remained that for Indian market, quality businesses haven't had any valuation definition or a range or a limit. We have over the period of time continued to see the valuations valuations band continuing to go higher and higher for the quality businesses. So that is one thing. Two, of course, for the short-term participants of the market, they have to look at the momentum. But by saying that, what I mean is, if we look at the FMCG stocks within the consumption space, we can very clearly see that they haven't gone anywhere in, let's say, last 2 months or so, whereas the index has continued to go up, which in fact means that could they be the next one to participate if market continues to go up? So one has to keep that in mind. Yet another thing is the demand sustenance and the demand recovery around the festival time. How will that shape up is something that is to be kept in mind. But given the fact that largely from the consumption space, we have quality businesses with good cash flows, good margins, good return ratios, quite a lot of them net cash flow generating businesses, and the consumption theme can spread across multiple spaces. So we have FMCG within consumption, we have durables within consumption. If we want, we can classify, let's say, agrochemicals and pesticides within that consumption. Of course, that consumption is related to the cropping. Then we can probably extend the digital businesses, the telecom businesses within the broader consumption theme. We can probably bring in automobile also within the broader consumption themes. So yes, my view on all these remain positive. As I said, one has to look whether one is participating for the short term, and as a result, is he with the momentum or against the momentum? And one has to look at the valuation comfort if one wants to look at that.
Okay, fair enough. Kunj, thanks very much for sharing with us your outlook and giving us your view on the markets.